In-depth analysis of soaring gold prices and prospects to 2030. 1. Executive summary. Gold prices are currently witnessing unprecedented growth, recently surpassing the 3,000 United States dollars per ounce mark. 1. This report will delve into the ambitious forecast that gold prices will reach $9,000 USD by 2030 and even higher, while examining the critical macroeconomic and geopolitical factors impacting the gold market, including money printing, public debt, wars, geopolitical tensions, trade wars, and the risk of stagflation. This analysis will provide an overview of these complex factors and offer a nuanced assessment of the feasibility of the $9,000 forecast. 2. Current gold market situation. Riding the wave of uncertainty. Recent price developments and milestones. Gold prices have experienced a remarkable surge, notably achieving new all-time highs above 3,000 United States dollars per ounce in March 2025. 1. Specifically, spot gold reached an all-time high of 3,037 United States dollars and 57 cents per ounce on March 18, 2025. 1 and has continued to trade near these highs. 4. The crossing of the significant psychological threshold of $3,000 USD marked a pivotal moment in the precious metals market. 1. The speed and magnitude of the recent price increase indicate a significant shift in market sentiment towards gold. Historically, gold prices have tended to move more gradually, so the rapid ascent past a major psychological barrier suggests a confluence of powerful drivers. The consistent achievement of new record highs indicates a sustained upward momentum rather than a temporary spike. Each new record high confirms that previous resistance levels have been broken, potentially paving the way for further gains. Factors driving immediate growth. Geopolitical tensions, particularly in the Middle East, serve as a primary factor driving safe haven demand for gold. 1. Uncertainties surrounding trade policies, especially those involving the United States, are another significant driver. 1. Additionally, central bank buying, notably from China, has contributed to the price surge. 1. While seemingly contradictory to the user's stagflation premise, slowing inflation in the U.S. may also have an impact. 1. The convergence of these geopolitical and economic uncertainties creates a robust environment for gold as a safe haven asset. Investors tend to seek assets perceived as stable and uncorrelated with traditional markets during times of uncertainty. Gold fits this profile. Central bank gold purchases provide strong fundamental support for gold prices, indicating long-term confidence in the asset. The decision to buy by central banks, which hold significant reserves, reflects strategic considerations regarding currency diversification and economic stability. Technical analysis perspective. Technical indicators on the daily chart suggest that the upward momentum is likely to continue, with indicators heading north without signs of exhaustion. 4. Potential resistance levels are around $3,040 USD and higher. 4. Nearby support levels are around $3,010 USD and lower. 4. Technical analysis reinforces the current bullish trend, suggesting the potential for further price increases in the short term. Technical indicators such as the Relative Strength Index, RSI, and moving averages provide insights into market momentum and potential future price movements based on historical patterns. Table 1. Recent gold price performance, March 2025. This table provides a clear overview of the recent gold price surge, highlighting key figures for better user understanding of the current market situation. 1. Money printing and inflationary pressures. Traditionally, gold is considered a hedge against inflation and currency devaluation, factors that can be triggered by excessive money printing. 6. As the money supply increases, the purchasing power of fiat currencies can decrease, making gold, with its limited supply, more attractive. 22. History has recorded instances of currency devaluation leading to increased demand for gold. 22. The inverse relationship between the US dollar's value and gold prices has also been noted. 8. Continued money printing by central banks globally could erode confidence in fiat currencies and further bolster gold's appeal as a store of value. If governments continue to finance deficits through monetary expansion, the intrinsic value of their currencies may be questioned, leading investors to seek alternatives like gold. The weakening of the US dollar, potentially due to concerns about economic policies and debt levels, directly benefits gold prices as it becomes cheaper for holders of other currencies. Gold is typically priced in US dollars, so a weaker dollar increases demand from non-dollar-based investors. Surging public debt. Global and national debt levels are escalating. 17. Projections suggest that global government debt could reach nearly $130 trillion USD by 2028-38 and exceed $100 trillion USD in 2024-40. The U.S. national debt has surpassed $35 trillion USD, and debt servicing costs are rising. 39. High debt levels can raise concerns about governments' ability to repay and their creditworthiness, potentially weakening their currencies. 9. The historical correlation between rising U.S. national debt and increasing gold prices has also been observed. 35. The unsustainable trajectory of global public debt creates a fundamental tailwind for gold as investors seek a safe haven from potential sovereign debt crises and currency devaluation. High debt burdens can lead to inflationary pressures or economic instability, both of which tend to drive investors towards gold. The trend of central banks diversifying away from U.S. dollar reserves into gold, partly due to concerns about U.S. debt, further supports gold prices. 9. This represents a significant shift in global reserve management and indicates a lack of complete faith in the long-term stability of the U.S. dollar. This table visually illustrates the growing global debt burden, providing context for its potential impact on gold prices. 38. 4. Geopolitical instability and safe haven demand. The flight to safety. Wars and armed conflicts. Wars, political instability, and international conflicts create uncertainty, prompting investors to seek safe haven assets like gold. 6. History has witnessed gold prices surge during major conflicts such as World War I and II, the 2001 terrorist attacks, the Russia-Ukraine war, and the Israel-Hamas conflict. 12. Wars can lead to increased government spending and money printing, devaluing currencies and boosting gold prices. 7. The current level of global geopolitical tensions, with ongoing conflicts and potential new hotspots, provides strong support for gold's safe haven appeal. As long as geopolitical risks remain elevated, investors are likely to continue allocating a portion of their portfolios to gold as a hedge against potential market shocks. Gold's historical performance during crises reinforces its perception as a reliable store of value in times of turmoil, creating a self-fulfilling prophecy of demand during chaos. Investors' past experiences and the widespread belief in gold's safe haven role drive buying activity during geopolitical events. Trade wars and economic instability. Trade disputes and protectionist policies, such as those involving the U.S. and China, contribute to economic instability and fuel demand for gold. 1. Trade wars can lead to concerns about a global economic slowdown and increased inflation, stagflation. 9. There have been instances of gold prices surging following the imposition of tariffs and the escalation of trade tensions. 9. The potential for further escalation of global trade conflicts poses a significant risk to economic growth and could continue to drive demand for gold as a safe haven. Trade wars disrupt supply chains, increase costs for businesses, and create uncertainty about future economic prospects, making gold an attractive alternative to riskier assets. Gold's historical outperformance during periods of trade tensions suggests that investors view it as an effective hedge against the negative economic consequences of such disputes. Gold's lack of correlation with equities and its perceived stability make it a preferred asset during trade-induced market volatility. 5. The threat of stagflation. A golden scenario? Stagflation is defined as a combination of slow economic growth, high inflation, and potentially rising unemployment. 19. There are growing concerns about stagflation in major economies like the US and Europe. 19. Gold's historical performance during periods of stagflation, particularly the 1970s, shows that it achieved significant gains. 19. Gold tends to perform well during stagflation because it acts as a hedge against inflation and a safe haven during economic stagnation. 18. In a stagflationary environment, rising costs and weakening demand can negatively impact other asset classes like stocks. 29. If the global economy enters a period of stagflation, as some analysts fear, gold prices could rise substantially due to its historical role as a hedge against both inflation and economic stagnation. Stagflation erodes the value of traditional investments, making non-yielding assets like gold relatively more attractive for preserving purchasing power. The current combination of trade tensions, supply chain disruptions, and potentially slowing economic growth creates a fertile ground for stagflation, increasing the likelihood of strong performance for gold prices. These factors can simultaneously lead to higher prices, inflation, and reduced economic activity, stagnation. 6. Assessing the $9,000 forecast for 2030, ambitious or achievable. Reviewing current gold price predictions. There is a range of gold price forecasts for 2025 and 2030 from various financial institutions and analysts. 1. Many forecasts for 2025 fall within the $2,700 to $3,300 USD range. 1. More optimistic predictions for 2030 include $5,155 USD, Investing Haven, StoneX Bullion -52, $7,000 USD, Charlie Morris -43, and scenarios reaching $10,000 USD under extreme conditions. 53. The $9,000 USD forecast sits at the higher end of current predictions. While a significant increase in gold prices is anticipated by many by 2030, the $9,000 USD target represents a substantial jump from current levels and consensus forecasts. Most analysts, while bullish on gold, have not projected such a dramatic increase within the next 5 years. Analyzing feasibility based on driving factors. For gold to potentially reach $9,000 USD by 2030, it would likely require a severe and prolonged combination of runaway inflation significantly higher than current expectations, potentially nearing hyperinflation, a major global financial crisis or sovereign debt defaults leading to a complete loss of faith in fiat currencies and traditional financial assets, a significant escalation of geopolitical conflicts, potentially involving major global powers, creating unprecedented levels of uncertainty and safe haven demand, a substantial and sustained weakening of the US dollar due to poor economic management or a loss of its reserve currency status, strong and sustained gold buying by central banks as part of a de-dollarization trend. Reaching $9,000 USD by 2030 is plausible but would necessitate a convergence of highly disruptive and negative global economic and geopolitical events. Such a dramatic price increase would require a significant deviation from the current economic trajectory and analysts' expectations. Potential catalysts and risks. Potential catalysts that could accelerate gold's price increase include unexpected geopolitical shocks, a sudden surge in inflation expectations, a sharp decline in the US dollar, or a major sovereign debt crisis. Risks that could hinder gold's price increase include the resolution of geopolitical tensions, a strong and sustained economic recovery reducing safe haven demand, aggressive interest rate hikes making gold less attractive compared to interest-bearing assets, or a strengthening of the US dollar. The actual trajectory of gold prices will depend on the interplay of these complex and interconnected factors, making the $9,000 USD forecast highly sensitive to future events. The global economic and geopolitical landscape is highly dynamic and unpredictable, with numerous factors capable of significantly influencing gold prices. 7. Gold as a long-term investment and store of value, a timeless asset. Gold has long served as a traditional store of value, particularly during times of economic and political uncertainty. 3. It carries no credit risk and has the potential to maintain purchasing power over the long term. 7. Gold also acts as a diversification tool in investment portfolios due to its low or negative correlation with other asset classes. 3. However, it is important to note that gold does not generate yield, which can be a disadvantage compared to interest-bearing investments. 17. Despite not generating income, gold remains a valuable component of a well-diversified investment strategy, offering protection against systemic risks and long-term currency devaluation. Gold's unique characteristics make it a hedge against various economic uncertainties that can impact other asset classes. 8. Conclusion and future outlook. Navigating the golden path. The primary factors driving the current increase in gold prices include geopolitical tensions, trade uncertainties, safe haven demand, central bank buying, and concerns about inflation and public debt. While the $9,000 USD forecast for 2030 is ambitious, the convergence of potential macroeconomic and geopolitical risks suggests that gold prices have the potential to continue their upward trend. However, the actual price trajectory will depend on the evolution of these factors, which are inherently uncertain. A nuanced perspective suggests that while a surge to $9,000 USD cannot be ruled out, it would require extreme and potentially destabilizing global events. A more moderate yet still significant increase is a more likely scenario based on current trends and forecasts. In conclusion, considering gold as part of a long-term investment strategy is crucial, especially in the current environment of heightened global uncertainty.